Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze 3M. Last, they generated a revenue of $32 billion and they have a market capitalization of $89 billion. They can be found in the industrial sector, where they have around 95,000 employees. The revenue can be divided into 5 main segments. These are safety and industrial with 37%, transportation with 27%, healthcare with 26%, consumer with 17%, and elimination of dual credit with 7%. The revenue can also be divided geographically. The largest quantity comes from America with around half. Next comes Asia and Pacific with 30%. And after that, Europe, Middle East and Africa with the last 19. Now I'm going to determine how much I should pay for the stock. To determine what the fair value of the stock could be, I start with looking at the dividend yield in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio. To smooth out the curve, I take the 5 years moving average of the dividend yield. The simpler approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.85%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. I can measure the volatility by calculating the relative standard deviation, which in this case is 17.7%. To the historical yield, I add a margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. From this value, I get information about how much the dividend yield differs from the reality, which in this case is the historical yield line. As said before, the relative standard deviation is 17.7%, which is fairly high, as seen in the rating scale. Therefore, I add 5% to the margin of safety. My next criteria is the dividend growth. In 2011, $2.20 were paid, and in 2022, $5.69 is expected. The company has a dividend history of 64 years of consecutive dividend increasement, and in the last 5 years, the average dividend growth was 9.48%. The 5-year dividend growth is in the light green section, which means 5% is being subtracted from the margin of safety. I'll find out if this dividend growth is healthy for the company by looking at the payout ratio. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from 3M increased from $5.37 billion in 2019 to $5.85 billion in the last 12 months. The cash dividend were respectively $3.37 billion and $3.49 billion. The average payout ratio since 2019 is therefore 58%. The value is in the yellow section of my rating scale, therefore no further adjustment is made. Next, I'll take a look at the debt situation. The company has a debt of $19 billion and have $5.73 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBIT, the debt to equity ratio is found. The EBIT is currently at $7.8 billion. This gives a debt to equity ratio of 170%. This means it will take just under 2 years to pay off the debt if the whole EBIT were used for this. Once again, the value is in the yellow section. Last, I'll take a closer look at how the business is going. The revenue has increased from $32.14 billion in 2019 to $35.36 billion in the last 12 months. This gives an average growth of 3.2%. In the same period of time, the EBIT increased from $6.31 billion to $7.79 billion, which gives an average growth of 7.3%. The margin is found by dividing the EBIT with the revenue, which in 2019 gives 19.62% and in the last 12 months increased to 22.3%. The margin therefore increases with 3.9% in average each year. An EBIT growth of 7.3% is in the light green section of my rating scale. Therefore, I'll subtract 5%. For an average margin growth of 3.9%, I'll subtract 5% as well. Every adjustment to the margin of safety has now been gathered. Plus 5% for the relative standard deviation, minus 5% for the dividend growth, minus 5% for the EBIT growth, and minus 5% for the margin growth. The new margin of safety is therefore 15%. This leads to a desired dividend yield of 3.28%. By a current dividend of $5.96, I should therefore don't pay more than $181 for the stock. By ignoring the margin of safety, the fair price of the stock is determined to be $208. These values can also be shown in the graph for the historical yield. To do this, I just add the line with the margin of safety in the graph for the historical yield. As seen in the graph, the yield line is over the margin of safety line, and therefore I consider the stock as underpriced. Finally, I consider the stock at its fair value when the price is $208. I will buy the stock at $181, and the stock price is currently at $144. If you did like the stock analysis, please consider to give the video a like and subscribe to my channel for weekly content.